Now, Market Navigator viewers will know that earlier this week we looked at overbought levels in names like Altria and Philip Morris in that kind of flight to safety consumer staples trade. Now, today, one of our traders is seeing evidence of that crowding, kind of widening out so fast that the institutional investors are starting to go so far as to hedge that downside hedge, so to speak. We're going to dig into it. Mike Khouw is our chief strategist with OpenInterest.PRO. He joins us now. So, Mike, let's talk a little bit about what the options market is telling you about just how much safety demand there is.
Yeah, I mean, obviously we can see that in the performance today. If you take a look at staples, they're materially outperforming XLP, which is the staples ETF. We can see that's essentially unchanged today. But as you pointed out, a lot of these staples names are sort of getting into stretched territory on a relative strength basis. And we did see more than 2 times the average daily put volume in XLP already today. It's actually traded 5 times as many puts as calls. And that's largely the result, as you point out, of a large institutional trader trading those puts. Specifically, what they were doing was buying the October 81 puts, bought 2,500 of those, paid about 72 cents a contract, and then sold twice as many of the 77 strike puts at a quarter apiece. It's a net debit of 22 cents. This isn't a massively bearish bet, but what it's basically saying is this may have come a little bit too far, too fast, and looking for a pullback. And I would make one other quick point. One of the names you didn't mention was Costco. Costco is one of the largest constituents of the staples ETF. It represents about 14% of it. And although some of the staple stocks remain, reasonably valued, shall we say, Costco is about as expensive as it has ever been, and it's going to be reporting earnings on the 26th of September.
So then how exactly would you go about hedging the hedge? If we know that consumer staples are the way that people have been seeking some of that protection, the less volatile play, maybe even some income on the side with dividends, if that trade has now become stretched, what then do you do for that hedge that is maybe not the institutional level trade that you just spoke about?
Yeah, I mean, so, the thing is, staples still remains, I think, a place that's not hugely risky, but I just think that if I was going to be inclined to own it, I'd rather do so at lower levels. I actually made a slight adjustment to that institutional trade, and I was sort of dipping my toe in the water to see where we could get a trade like this off. I actually migrated those strikes down slightly. So I bought the 80 strike puts that expire in October, and then I sold twice as many of the 76 strike puts. I spent about 16 cents per spread to put that on. So basically, if the staples do pull back, I'd make my peak profits right around that $76 level. Now, the downside, of course, is that potentially if it really blows through that short strike, I could end up owning the staples. But, at 21 times earnings, which is probably a mean multiple for them, if it does pull back in that 14, 15% neighborhood, which is what we would be talking about, I'd be comfortable owning it there.
And then one last point here. If you take a look at this Navigator type theme that we have going on right now, are there any other signs that you're seeing in the marketplace right now that lend you to believe that we could be due for some material downside, maybe broader and not just outside the realm of staples?
Yeah, I mean, actually, we've been seeing that for a little bit, actually. So if for those viewers who actually lived through the tech wreck and some other eras where we saw some extended valuations, one of the characteristics of the market that I observed back then and that I started to observe now was usually when the market rises, we expect volatility to fall. But that isn't necessarily true when you start getting towards periods that precede either a correction, a decline of 10%, or even, I hate to say, bear markets, 20% declines or more. What you often see is that volatility rises even as stock prices are rising. And there is, intuitively some reason why that might be true. You can imagine that people get increasingly nervous that maybe things are a little bit extended. And that's what contributes to those sort of gaps that you see, both up and down. Fear of missing out to the upside and concerns that we might have come too far too fast on the downside. And we did see that. We saw NVIDIA behaving before this recent decline a lot like Cisco did, actually, in 99 and early 2000. So I think there are a number of other parallels.
All right. Mike Khouw with the hedging the hedge trade. Thank you very much. Have a nice weekend. We'll see you soon.